Hey everyone, and welcome. Today we're tackling a core concept in investing, the relationship between risk and return. It sounds intimidating, but it's actually pretty straightforward, and understanding it is crucial whether you're a beginner or have been investing for years. So, what is the risk-return trade-off? Simply put, it's the principle that the potential for higher returns generally comes with higher risk, and conversely, lower risk investments typically offer lower returns. It's not a guarantee, of course, but a fundamental tendency in the world of finance. Think of it like this. You generally have to take on more uncertainty to potentially earn more money. Now, why is this particularly relevant to us here in the US? Well, Americans have a huge variety of investment options, from incredibly safe Treasury bonds to highly volatile growth stocks. We're constantly bombarded with opportunities, and it's easy to get caught up in the hype of get-rich-quick schemes. But those schemes rarely acknowledge the risk involved. Understanding this trade-off helps you separate realistic opportunities from unrealistic ones and build a portfolio that aligns with your goals and your tolerance for potential loss. Let's break down how this actually works with some simple examples. Imagine you're deciding where to put $1,000. Option 1. You put it in a high-yield savings account. These are generally FDIC insured, meaning your money is very safe, essentially risk-free. You might earn around 4 or 5% in interest over a year. That's a modest return, but you're highly likely to get your principal back. This is a low-risk, low-return scenario. Now, let's say you're a little more adventurous. You decide to invest in a U.S. Treasury bond. These are backed by the full faith and credit of the U.S. government, making them incredibly safe, still relatively low risk. You might get a return of around 4.5% to 5%, slightly better than the savings account, but the risk is still minimal. Let's step up the risk a notch. You decide to invest in a broad market index fund, like one that tracks the S&P 500. This means you're buying a small piece of 500 of the largest U.S. companies. Over the long term, the stock market has historically returned around 10% per year on average. And this is a big but, the market goes up and down. You could see your investment value decrease significantly in any given year. This is moderate risk, with the potential for moderate to high return. Finally, let's consider a really high-risk option. Individual growth stocks, maybe a relatively new tech company. These stocks have the potential to skyrocket in value, giving you huge returns. But they also carry a significant risk of losing a substantial portion, or even all, of your investment. The company could fail, the technology could become obsolete, or the market could simply turn against it. This is high risk, with the potential for high return or significant loss. Think of it on a scale. On one end, you have incredibly safe investments like Treasury bills or FDIC-insured savings accounts. These offer very low returns, but also very low risk. On the other end, you have speculative investments like penny stocks or cryptocurrency, which offer the potential for massive gains, but also carry a very high risk of loss. Most investments fall somewhere in between. Your personal risk tolerance plays a huge role in determining where you fall on that scale. Someone nearing retirement might prioritize preserving their capital and prefer low-risk investments, even if it means lower returns. They can't afford a significant loss. A younger investor, with a longer time horizon, might be comfortable taking on more risk in pursuit of higher potential returns. They have time to recover from any losses. Diversification is also key to managing risk. Don't put all your eggs in one basket. By spreading your investments across different asset classes, stocks, bonds, real estate, etc., you can reduce your overall risk without necessarily sacrificing potential returns. If one investment performs poorly, others may offset those losses. It's also crucial to remember that risk and return aren't always directly correlated in the short term. Sometimes, low-risk investments can outperform high-risk investments and vice versa. But over the long term, the relationship generally holds true. higher potential returns typically come with higher risk. So to recap, the risk-return trade-off is the principle that higher potential returns generally come with higher risk, and vice versa. It's a fundamental concept in investing that's relevant to everyone. Understanding your risk tolerance, diversifying your portfolio, and focusing on long-term goals are all crucial to navigating this trade-off successfully. It's about finding the right balance between risk and return that aligns with your individual circumstances and helps you achieve your financial goals. It's not about eliminating risk altogether, but about understanding it, managing it, and being appropriately compensated for taking it. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.